This is a bit different from the normal videos I make, but I felt like I had to make this video. So recently I encountered a self-assessment tax rule that caught me completely off guard, and it almost crippled me financially. So let's break this down. A self-assessment is essentially a way for an individual to declare their income so that you can then calculate the amount of tax you owe to HMRC. It's normally something that's required of people who have additional incomes outside of their normal salary. For example, if they do freelance work, or they get interest on savings accounts, or they get rental incomes and things like that. Let's say you earn more than £50,270 per year. That would put you in the 40% tax bracket. Simple enough, right? Now, let's assume that you bring in an additional £10,000 per year from renting a property or getting interest on savings accounts. In theory, you'd expect to pay 40% of that 10,000, right? £4,000 in tax. Seems straightforward, but here's the kicker. You actually don't pay £4,000, you actually need to pay £6,000. It's a system called payments on account, and I was not aware of this. It came as a big shock to me. Basically, HMRC assume that in the next tax year, you will owe the same amount of tax, and they want 50% of that assumed future tax to be paid now, along with the money you already owe from the tax year you've just completed your self-assessment for. So instead of paying the £4,000, you actually need to pay 150% of this up front. So the £4,000 from the money you owe, plus £2,000, which is 50% of the assumed future tax for the next tax year. And then on top of this, at the end of July, you also need to pay the remaining 50%. So in this example, it would be another £2,000 at the end of July. So basically, I thought it was going to be calculate, pay. Next tax year, calculate, pay. Next tax year, calculate, pay. But actually, it turns out it's more like calculate, pay again, and then adjust. Now, I don't know about you, but to me, that seems pretty unfair. Now, at the end of the day, the system is not going to take more money than it should in total. In the long run, things will even out. The amount will just be adjusted to the correct level when I fill out next year's self-assessment. And actually, you could even argue that this is a way of getting a head start on paying next year's tax now. But in terms of cash flow, it is brutal, especially if you have kind of fluctuating income, you have money tied up in different accounts, or you're expecting the next tax year to be much lower in the amount of tax you owe. Something about this just makes me feel very uneasy. It feels like I'm having to pay next year's taxes now, like before they're even due. Now, I'm not a tax expert, so maybe there are ways around this. Maybe this does not affect everyone and I've just been unlucky, but I wanted this video to serve as a warning. If you are filling out a self-assessment and you've put aside a certain amount of money based on what you think you owe, just be prepared that there is a chance you'll actually have to pay 150% of the amount you owe straight away. I think it's much better to be prepared than to be blindsided later, like I was. If this comes as news to you, then I would suggest you research payments on account, budget accordingly, and of course, seek professional advice if you need to. Anyway, I hope that helped. Thank you for watching, and I will see you in the next video.